Tesla is forcing the market to reconcile a contradiction. Investors are caught between deteriorating auto sales and explosive AI hype. Look at the immediate market reality. The stock closed today at $372.11, suffering a daily drop of nearly 3.6%. That downward pressure was triggered directly by the company's own guidance. Tesla recently released a reduced estimate for its upcoming electric vehicle deliveries. The core brio business is facing heavy macroeconomic headwinds. Even with historically high gas prices, consumers are pulling back, and expensive oil is no longer providing a default boost to EV sales. Contrast those delivery cuts with the CEO's narrative. Elon Musk recently announced a $20 billion Terafab compute project, pivoting focus toward massive AI infrastructure. Adding to the noise are proxy catalysts. Rumors of a $75 billion SpaceX IPO are actively injecting unpredictable speculative volume into Tesla shares. Meanwhile, competitors like Meta are successfully executing highly focused, dedicated AI strategies, openly targeting trillion-dollar valuations without the drag of a capital-intensive manufacturing arm. Anyone trading this stock right now faces a clear dilemma. You have to decide if you are evaluating a struggling car manufacturer or placing a highly speculative bet on an early-stage AI infrastructure builder. This chart shows the recent performance of the Magnificent Seven tech stocks. Tesla's correlation with the rest of the group has broken down, with shares diverging to a negative 17.26% return year-to-date. Even with that drop, the valuation multiples remain staggering. The stock carries a trailing PE ratio of over 345 and a forward PE of 141. The price-to-earnings, or PE ratio, is a metric measuring a company's current share price relative to its per-share earnings. Compare that massive growth premium against the reality of Tesla's actual balance sheet. Their profit margins have been compressed down to a razor-thin 4.00. Chief Financial Officer Vaibhav Taneja, Director Kathleen Wilson-Thompson, and James Murdoch have systematically liquidated millions of dollars in personal shares over recent months. These insiders are actively choosing to secure liquid cash profits today, rather than holding their capital through the expensive, unproven Terafab build-out. When retail buyers purchase shares at these elevated multiples, they are often serving as the exit liquidity for those cautious corporate executives. With bearish business fundamentals and heavy insider selling, you cannot treat this as a passive value investment. It requires ruthless, tactical trading mechanics. To survive Tesla's brutal average weekly volatility, we use the Pivot Playbook, a non-negotiable risk management framework. First, implement strict position sizing. Limit capital exposure to a maximum of 1 to 2% of your total portfolio value per trade. This strict cap is mandatory to survive sudden negative catalysts, such as regulatory blockades slowing self-driving tech approvals. Second, use dynamic trailing stop losses. A trailing stop loss is an order type that automatically adjusts its trigger price upwards as the stock moves in your favor. These automated orders lock in your profits during violent upward swings. The trade-off is that you carry the explicit risk of getting wicked out of your position by normal intraday market noise. This framework forces you to prioritize survival and capital preservation over the fear of missing out on a sudden, unannounced SpaceX sympathy squeeze. The final rule demands technical confirmation, explicitly preventing you from attempting to patch a falling knife in the market. When a stock drops 3.5% in a single session, the urge is to impulse buy the dip, assuming it must be the bottom. Technical confirmation requires waiting on the sidelines until massive institutional volume steps in to clearly establish a reliable price floor. You will deliberately miss the exact bottom and sacrifice the first 3 to 5% of the rebound. In exchange, you exponentially increase the probability that the trade will actually succeed. Mastering entry timing is the critical differentiator between gambling on Elon Musk's social media feed and executing a calculated swing trade. This annotated OHLC candlestick chart shows Tesla's recent downward price action, allowing us to map the exact setup. An OHLC chart is a visual tool that displays the open, high, low, and closing prices for a stock over a specific time period. We apply our framework to execute the news absorption bounce. We are betting the underlying Terafab AI hype provides a technical floor against recent vehicle delivery cuts. Wait patiently for the stock price to fall into the designated buy zone, located between $355 and $365. If the stock reverses before reaching this consolidation zone, the setup is automatically invalid. You do not chase the trade. To prevent catastrophic loss, set a hard stop loss precisely at $340. This boundary protects your portfolio if bearish momentum accelerates, even though it leaves you vulnerable to a targeted market maker stop hunt. A stop hunt is a scenario where large players drive prices towards obvious stop-loss levels to trigger them and create liquidity. Set your rigid exit target at the current analyst consensus of $426.26. This setup provides roughly a 2-to-1 reward-to-risk ratio. But you only secure that math if you have the discipline to take profits at the target, ignoring higher numbers based on media hype. This trade is built exclusively for the tactical swing trader. At a trailing PE of 345, the multiples make this stock highly dangerous for traditional investors. Successfully trading Tesla's identity crisis means stripping away the emotion of its founder's futuristic visions and executing strictly on the mathematical reality of its volatility.